today. The objective of the discussion will be twofold. First, describe the risks our institutions face in the execution of their payments, and second, see how the network management function can anticipate and manage these risks. So I have the pleasure to welcome on stage and remotely plenty of competent people. Greg from UBS, Sid from Stanchart, Zaid from Bank of America, and Kumar from JP Morgan. So let me join you. So my first question would be for you, Greg, to kick off our discussion. I propose to start with a kind of testimony coming from you. Credit Suisse over the last year went through a severe crisis, and in the context of your agent bank network role, I would like you to share with us some insights, some experience that you had at that time, what struck you the most, and what you learned from that.
Okay, thanks, Jean-Francois. Let me just check you can hear me okay. Yeah, good. Okay, so good morning, everyone. We go from fintechs and the future on the past panel to the global banks and wholesale payments world on this one, so I apologize if I sound a bit sort of 2008 maybe on this. Look, this is a big topic. It's got so many facets. I'm going to keep it very much in the context of a discussion on network resilience rather than everything else that we experienced with Credit Suisse back last year. First thing I'm going to say is that the Credit Suisse situation wasn't a crisis of network. So it's not a typical resilience topic in the sense of you provide a mix, alternative providers, alternative channels, etc. But the symptoms of the overall bank stress very much pushed down into the network, making the agent bank relationships, particularly the cash correspondents, a real key priority for the bank. The second sort of main point is in any crisis, in my experience, and prior to being a head of network, I was the head of cash and intraday liquidity. In any crisis, the most important topic is cash. Where is the money? Who's paid us? Who hasn't paid us? Who haven't we paid? So ensuring that your critical payments continue is absolutely essential and key, which means network management functions and cash management functions become absolutely key, not just to any sense of BAU, but to actually running the bank hour to hour to get through that stress period. If I go back to March last year, sort of the days before the merger was announced, and then sort of the following weeks, probably the strongest impression I take away from the network is the enormous level of partnership across banks, which comes to network very much in terms of choosing the right partner banks with strength in depth across their organizations, but also very much investing the time to get to know your banks, both at the relationship level, but also with the product teams, with the operations heads, with the processing teams, with everybody who's involved in providing the service. All those on-site due diligence trips, conferences, drinks receptions, dinners, where you meet people, that builds that sort of personal connection, which in times of stress is priceless. And thinking back to the previous conversation, very much on the client side, yes, fintechs and instant payments are great, but when you actually have significant problems, you definitely need people with experience and knowledge to help you through. And that's exactly what we experienced in that stress period. People giving up their hours, their weekends, in some case holidays, to make sure that we got the best possible outcomes. So the real takeaway, I think, the learning point from that is you can't do too much to connect your organization. So as a network management head, I see it as my job to bring the network into the bank and to make sure that we're connected at every level. The second big takeaway from me, I think, from that stress period is it's been 15 years plus since the global financial crisis. Many people who were in senior roles and decision making at that point aren't here anymore. They've retired. we've also had 15 years of low interest rates. We've had a raft of post-financial crisis regulations. Everyone's got a bit of a sense of safety. So maybe sort of the fundamentals of cash management aren't the top priority, but you see how quickly things return to those fundamentals in a stress. I mean, the US tier 2 banks and the issues that we saw there that sort of created a bit of market uncertainty. That really brought cash right back into the focus for everybody. And you could see, working with the banks across the network, those people who had that first-hand experience from previous crisis sort of management versus not. So the value of those people is huge. And I think probably, if I had to say why, the impression I took is people who've got those scars of crisis management think about protecting their own bank, but they also think about the ecosystem and protecting the overall ecosystem. So for me, that was one of the real big takeaways from last March.
Thank you, Greg. Maybe, well, to stay with you, well, we've seen that among all the risks that we have to face, to manage as institutions, maybe the one having the fastest killing power is liquidity. Could you rapidly share with us some good guiding principles in terms of liquidity risk management? Is there any corollary that are, in your view, relevant to monitor this scarce resource? What is your view on that?
Yeah, intraday liquidity is totally at the sharp end of this. That it's the next critical payment obligation is the most important. So you're absolutely right in terms of the priority. Continuing to meet those critical obligations is absolutely key. So things like margin calls, CCP margins, CLS pay-ins are absolutely critical, because any failure on those, obviously, it's very public, very visible. You get notified of being in default. The market sees that, and everything spirals. Equally, on the client side, continuing to meet client payment SLAs is also essential, and this really does tie back to the previous panel. In the digital age, the speed at which information passes around is incredibly fast. Information and rumor, to be frank. And therefore, the speed with which clients can act is also very fast. So you have to be able to keep up with that demand. And all of this comes down to planning, essentially, particularly for intraday liquidity. Plan your resources, make sure that the people managing intraday across the banks, and it's not just the cash management, it's your settlement teams, it's even your trading, it's everybody who's involved in creating cash flows through the network to have intraday liquidity in mind at all times with what they're doing. But having those experts with that in-depth knowledge across treasury, cash management, operations, correspondent banks, clearing, that lets you adapt those plans as well. But also for me, planning for those scenarios. What if? What could happen? How could it happen? How quickly could it happen? What are the tools you have available, and what's being tested? I think you have to involve everybody in that. So I think in terms of key principles, knowing your critical payments, what they are, which accounts they go through, what's your plan to fund them? If plan A doesn't work, what's plan B to fund them? Make sure everybody's involved in that planning and knows what they're doing. Knowing your Nostro banks is absolutely critical, as I've said, building those relationships. Data and monitoring over flows is very useful, but specifically on your question around KRIs, in my experience, intraday is a very fast-moving topic. So typically the triggers of an intraday stress come along very, very quickly, and they're not things you can sort of track from data that generally looks backwards. Most KRIs obviously are based on data points that have already happened, not on feelings that may drive behaviors going forward. So a lot of the KRIs that you might think of tend to look backwards, and they're more useful as a tool in planning rather than actually telling you that something bad's about to happen. I think monitoring headlines, monitoring social media, that gives you a hint of what's to come. But it's very difficult from a data and KRI's perspective to really have those forward indicators.
Well, thank you, Greg. Maybe it's the time to maybe take the view of another institution. First, Sid, are you, I know the answer is yes. Are you familiar with these concerns, and how do you integrate them in your network management policies and decisions?
Yeah, yes, the answer is. I would say, network management sits really in the middle, hence the word is in the clue, network. We're the voice of the business with the correspondent banks, and equally, we're the voice of the correspondent banks back into the business. And when you look at network management, Greg touched on it, Nostra accounts is really pivotal of what we do in terms of setting up accounts, management of accounts, and then closure of accounts eventually. So understanding liquidity is such a crucial part of the Nostra management piece. So we make a very conscious effort to understand the liquidity policies and procedures within our organization, and then ensure we understand the providers and what they set up. Because usually when you open an account, you get default, uncommitted, unadvised lines, and sometimes you need to put committed lines in place. And the costs and tricks that come with that. Now, the other thing which is interesting is viewing balance, because then you need to understand your exposure in a currency or with your provider. And it sounds easier than said. There are some markets and some currencies where you just don't even receive basic balance information. But finally is understanding when you do hit those stress points that Craig mentioned is what is the procedures that your providers follow in such scenarios, and being able to react to those and prepare for those. So to Craig's point, we make a conscious effort of introducing key internal stakeholders, be it treasury management team, be it operations, with our key currency providers.
Well, thank you. So I'm going to close the chapter around liquidity to open a new one around sanctions. The world has become less stable, more fragmented. We have never seen as many complex sanctions programs as today, triggering cost and risk, but also threatening our reach to certain currencies and geographies. At the same time, we have underlying clients having illicit transactions to get executed, or also within our institutions some exposure to unwind. Zaid, could you please share with you your recent experience on this? Can future sanctions programs be well or better anticipated, and how? And I would also be curious to see how you decide internally to cut the access to a given currency or market. Is there any governance on that? So sorry for the 3 questions, coming at the same time.
I've got them all, that's fine. Thank you. And good morning, everybody. Good to be back here at BAFT again. So firstly, the complexity of sanctions, that has not gone away one bit since I last spoke here. We continue to see different jurisdictional designations. An example practically is Gazprom Bank. So Gazprom Bank is not sanctioned from an EU perspective, but is from a UK perspective. That makes it very difficult where we are clearing through euros in Frankfurt and onward passing that payment to London, and that payment then has to be frozen. We see other differences still around ownership and control. The control concept doesn't exist under the OFAC US rules. It does in the EU and the UK, but it's still not aligned. There's different approaches to aggregation that continue. Navigating that environment becomes increasingly complex against a political landscape that's ever focused on preventing circumvention. We're now at 12 packages in Europe on Russia-related sanctions since February 2022, and we are at 7 in the UK. We'll take some bets on what we think the numbers will go up to. I have no idea. The clear focus is just around circumvention at this point. Mid-December, we saw oil price cap measures tightening. There was a revision on the tiering system for a 3A tier. There's also a requirement for attestations to be provided on a per journey basis. Again, all around circumvention. To your second point, can we anticipate what's coming down the line? A little yes, a little no. So we don't get a heads up as financial institutions of what sanctions are coming. But we can try to look at a little bit of the macro environment to ascertain some of that. For example, just 2 nights ago, we saw Trump's win by a landslide 30 points in Iowa. What does that mean for 2024? Could Trump come back in office? That night alone, we saw Chinese stocks drop between 1 and 1.5%. Certainly more sanctions on China would arise if Trump was to come back. We see a relaxing of Venezuelan sanctions last year by the US, but only really as a tool used to try to drive fairness in this year's election. If those objectives are not met, we will likely see an imposition of sanctions back on Venezuela. And finally, Iran. The US has stayed clear of further sanctions on Iran. However, given recent turmoils and allegations of their involvement in the situation in the Middle East, that will likely change shortly. And if it does, from a macro, we're talking about global oil supplies, the inventories decreasing because Iran last year increased their inventory supplies for oil, which helped globally. The next point you mentioned is around how do we look to divest positions. So that's a constant challenge. We do still hold positions ourselves, as many other institutions do. I'd say that battle so far has been to enable the regulators to understand that we need to divest positions. So in the 7th package, the UK has now finally put into law a ground for divestment. So that means if you need to divest, you can use that as a ground to apply for a license. Believe it or not, for the past over almost 2 years, that wasn't even a ground. You can divest, but it's very tricky. There's certain situations, you've got to think about the parties. If you're divesting to an entity in Russia using a Russian broker, how do you do that? Which personnel can be involved from the EU, from the UK, and then it's the various shades of grey with that Russian counterparty. So that comes on to the last point. And your last point was around the risk appetite of an institution. So compliance, my role, I definitely have a seat at that table, but it's not my view conclusively that matters. In fact, what we're seeing is, so we have a committee, we have various committees that these decisions will be taken at with the most senior executives in the company. But what we're seeing is the decisions not being taken on the basis of sanctions technicalities. For example, a very well-known company, which a number of you in the room will know without mention of the name, which has a 49.99% sanctions ownership, is in fact technically permissible to engage with from a sanctions perspective. However, is that something you want to do? And that is the question that typically occupies us on a daily, if not weekly basis, with new business, with existing business, with refinancing of facilities, etc. And the end outcome that we typically see is, it may be technically permissible, but is it responsible growth? I'll leave it there.
It's well said. Thank you, Zaid. Back to you, Sid. Are you expected to anticipate and manage potential geopolitical changes in your daily job and position and responsibilities? And if so, how do you do that?
Yeah, again, yes. It's not just geopolitical issues, so I mean that's absolutely crucial. But there's other factors that form part of the network management planning, including natural disasters, earthquakes, flooding, things you see around the world that impact the settlement of payments. Again, man-made issues such as geopolitical issues we've seen in Russia and Ukraine, and even in Israel now, and the 9/11 going back a few years. These are all real-life situations. If you take the Credit Suisse UBS situation, mergers and acquisitions, that impacts how we potentially settle. You've got regs that come in, and that impacts, again, how you settle in certain currencies. So there's various factors that you take as part of your planning. But it's important you do consider a contingency type approach in your key currencies. So one of the things we've done is we set ourselves a statement initially. What is our approach in certain markets, in certain currencies? And then we transfer that into a strategy. And for that, you need endorsements from various stakeholders, including compliance, including operations and product and other people, to buy into your strategy. And then network management goes out and executes that. Now, one of your recommendations could be risk acceptance, right? There's certain scenarios where you don't want a shadow network because the costs are too high or other factors come into play. But ultimately, it's important that you do consider having backup options, because we're here ultimately to ensure payments are settled.
We'll come to that later on. Thank you, Sid. Kumar, now another aspect of risk that is inherent to our payment activities. Please agree or disagree on that, but it seems that in our industry we have seen diverging trends or movements, one favoring concentration around fewer actors in correspondent banking, which has been raising some concerns, including at the IMF level at what point of time, and the other way around, the payment world getting more and more fragmented, with maybe more solutions compared to the past, both in terms of actors and rails. First, do you agree or disagree with that? And two, do you see any link that we could make between such a statement and the search of resiliency that banks nowadays are trying to have or to achieve?
Thank you and good morning. I'll take this opportunity to summarize the story around correspondent banking. So now it's an established fact that correspondent banking is a critical function, moving trillions of dollars, billions of dollars in liquidity, and truckloads of risks that come with it. It's the bedrock for global commerce and trade. Now, 25 years ago, correspondent banking was way more prevalent. There were smaller banks, regional banks that were able to provide international access to their underlying clients, and all that has changed in the last about 10, 15 years. This is largely driven by the regulatory, financial, and reputational risk that has completely changed the landscape of correspondent banking in the last 10 to 15 years. That has led to a concept called de-risking. So now the model has changed, where correspondent banking are looking at the risk and the cost versus benefit analysis and saying that some of the markets just don't make sense to bank in because of the heightened risk and the cost implications. So now what does this mean, right? So there's a study that was done by IMF that said that every 1% reduction in correspondent banking leads to about 0.05% reduction in the GDP growth of the recipient country. Now, correspondent banking over the last decade is actually booming in terms of business, right? So the payment volumes have gone up by 61%. The payment values have gone up by 37%. But the correspondent banking relationship have reduced by 29%. So this is the impact of the de-risking that is happening in the globe, right? So now, another study that was done by World Bank also says that if a nation has all the correspondent banking relationship removed, then that will lead to the remittances cost increasing by 5%, 500 basis points. So that's a huge implication. So there are vulnerable communities that are dependent on remittances, and there are nations which are impacted. The economic development of the nation is dependent on the remittances flow. So, and again, you know, there are about 50 plus countries where remittances make up more than 10% of their GDP. So these numbers are huge, right? So there's a huge impact on de-risking. So now, what are the options that these respondent banks and these nations have for financial inclusion, right? So one trend that we're seeing right now, especially given the geopolitical environment that we are in is a de-dollarization. So there are nations looking at options beyond US dollars and euros. There's no imminent threat to the US dollars as yet. It still controls about 80% of the share of global commerce. But then these are some of the options that some of the nations are looking at in terms of financial inclusion. The other thing that is potentially we are looking at as a trend is alternate payment rails. And in certain cases, it can actually be counterintuitive because these alternate payment rails can also be a less regulated framework, which is actually adding risk into our financial systems. So these are some of the trends that we are looking at. So to come to the second part of your question, right, as what can we do to protect this critical function, and what are the different options that are available as correspondent banks? So number one is a regulatory reform is imperative. I know, don't shoot the messenger. I know it's easier said than done. But this de-risking and this entire correspondent banking relationship reduction is largely driven because of this unclear and complex regulatory requirements and the reporting requirements, so on and so forth. So having a global standard that can harmonize around your regulatory requirements, your reporting, your liability, will help ensure and provide some certainty to correspondent banks and the respondent banks. The second is investing in technologies. So when you think about futuristic technologies like blockchain, CBDCs, central bank digital currencies, that's going to change correspondent banking the way we know it today. So banks have to be smart to see when to collaborate versus compete with the fintechs who are playing a huge part in reshaping the payments landscape. And they also play a huge role in the remittances space. So as banks, we have to decide when do we kind of add on services from fintechs, when do we compete, what does the business model look like, what does the risk look like, and then come up with a determination. But this model will help with financial inclusion for especially the nations that are getting de-risked and want to be included in the foreign markets. The third thing is, and by the way, in investing, when I say about technology, there are current technologies that we're currently focused on, which is like the ISO migration, the Swift Go value proposition around low value clearing value proposition. Then you have the instant cross-border payment connectivity. These are going to make cross-border payments much more efficient, faster, cheaper, transparent, and more accessible, which are the G20 goals and mission. And finally, I would say that investing in artificial intelligence and machine learning, so especially around the area of client onboarding, for example, in KYC, AML, the due diligence, that will definitely make onboarding less riskier, more intelligent, reduce cost, so we can have it a more inclusive in nature in terms of correspondent banking. So in short, there's a lot of work to be done with the correspondent and respondent banks to make it more resilient and all-inclusive.
Thank you, Kumar. So some go-fast questions, so that we will be allowed to keep some time for the Q&A. Sid, or alternative networks or providers a good way to get resiliency from a network management perspective?
Absolutely. I mean, you can't rely on traditional correspondent banking relationships or traditional rails. I think disruption and fintechs are healthy, not just in banking, but in general, because it keeps everyone on their toes and pushes the envelope. So absolutely, the answer is yes.
Thank you so much. Greg, back to you. In a few words again, what is a good backup plan?
In the real short end of the intraday time frame, I'm not sure there really is a backup plan per se. For me, it's more about resiliency in your sort of primary model and making sure that you've planned for every scenario to build that resiliency in. Any kind of alternate provider, change provider, when you're at the real sharp end of intraday, it takes time to operationalize. You have to inform people, you have to move instructions elsewhere, you have to move liquidity, which may have a dependency on your primary. And you risk creating more confusion. So for me, really, resiliency of plan A is critical. Where you've got major currencies, self-clearing, I think is a very good option. I think it takes out those intermediaries. It means it's all in your control, in your hands. Where self-clearing isn't an option for you, I think planning ahead in partnership, Sid mentioned earlier, having agreements in place, how to secure unsecured lines or commit uncommitted lines. All of that is forward planning that then gives you more resilience in plan A. If I had to say an alternate strategy in the real short term, I think having global relationships with the big banks who you can have accounts in multiple markets, they might not be your primary in a particular currency, they might be your primary somewhere else, but being able to use the accounts in other currencies and manage liquidity across currencies with a global bank, I think is a very useful plan.
Thank you. Sid, back to you. Does resiliency go against good prices?
Yeah, I mean, network management, we generally wear two hats, right? So we have our risk management hat around resiliency. We have our commercialization hat around cost. For me, they're co-current with each other, but it also depends on the need of the business. There's scenarios where you would try and source a provider and your driver is cost. In other cases, you would pay a little bit of a premium because having a resilient partner is important, right? So for me, I think if you're planning your thoughts around this, think about what your drivers are. Make sure when you're doing your assessment RFP process or however you're procuring that service is tailored to that need, and then really work with your providers and be transparent what's driving this particular appointment. And I think that will lead to, generally from my experience, in some cases, cheaper is not always the best. So you keep, often no, we want to pay the lowest price, yet have a premium service or a resilient provider. And sometimes it's accepting the fact that, there is a cost to having a good provider who's able to support your business.
Perfect. So before going to the Q&A, maybe in one word, it's going to be my last question. In one word, for each of you, what is the main takeaway of this discussion? Would like to start? Okay, Zaid.
Yeah, for me, it's volatility, and that's because from my seat, economic statecraft will continue to play a cornerstone role in this volatile world right now.
Thank you. So volatility, Kumar?
I would say reinvent, given the fantastic opportunities that we have for correspondent banking in the future. We have to reinvent ourselves.
Reinventing. Sid?
For me, I'd say adaptability, because the one constant in network management is change, right? So being able to be nimble enough to rethink and review things.
Nice words too. And Greg?
Sid, we should have planned this. I had adaptability as well. Plan for all the scenarios you can envisage, then be ready to react and adapt to the situations that arise.
Thank you to all of you. I've loved this discussion. Thank you so much. So now it's time to go to the Q&A, and we have one first question. Should network management be independent from transaction banking sales or not? So this is a long-standing debate in the industry. There is quite some divergence here by individual banks. Completely true. Is resiliency and independence impacted when sales teams also make network decisions? So, Greg or Sid?
I'm happy to kick off, and then Greg, maybe you want to add in. I think I've been in scenarios where network management have sat with sales, and there's been decisions largely reciprocity based, and I'm in a current environment where we're independent from sales, and having been part of both worlds, I think having the independence is super important, because ultimately your primary role as a network manager is making sure that we keep the lights on and payments are being made, and for that you have to have that independence in making the decisions. Now, we're not naive enough to think there are business decisions to be made as well, and we're all here for our shareholders essentially. So where you have a scenario if bank A, B, C are able to offer a very similar type of service and they pass all your checks and processes, then it becomes a commercial decision at the end of the day.
Yeah, I very much concur, Sid. I mean, Both the Swiss banks that I've operated in, network is independent from those sales teams. And I think it's important, the role of network is to select the providers who provide the services the bank needs. They do it at the appropriate level of risk and resilience at the appropriate price point. So that needs that independence. It can't be a topic of reciprocity, etc. I would say, though, we work very closely in partnership with those teams because, as you say, these are institutional relationships. We need to know what's going on across the relationship in order to manage the network side of the relationship. So independence is important, but also partnership and understanding what's going on across the business is also essential.
Thank you, Greg. Maybe the next one would be for you, Kumar. Is nesting a possible answer to de-risking in correspondent banking?
Yes and no. No, because nesting is a huge risk in itself, because you are not just, you just have your KYC and your knowledge and due diligence about your underlying client, not the client's client. So just by the very nature of nesting, it adds risk into the payment flow. Now, if nesting is done in a de-risking, that's an absolute no, because in the first place, you didn't want to market in that particular nation or that particular bank, and having them come through a nested flow adds to the risk. But say alternate models of nesting, like for example, nesting to the central bank, maybe a yes.
And maybe the other way around, from a network management perspective, or multiple currency accounts. So in a way, it's nesting. It could be a solution to get resiliency.
Absolutely. Again, it depends on institution. My institution, for example, we have 55 locations that potentially contract with a single provider. So there could be internal nesting beforehand within my world before we go out and make an appointment. And then to your point, of course, there are scenarios where you may want to use a single provider in multiple currencies.
Excellent. So we're perfectly on time. Thank you to all of you for for the content and you made it short, so it was perfect. Thank you so much. It's time for me to head you to the next session, which is not a session. It's a networking break that is kindly sponsored by Commerzbank, who I would like to warmly thank for that. Thank you so much.